So, usually when you talk about jumping out of an airplane, there's a pretty standard expectation for how the equipment is supposed to work.
Right. Yeah, you hope so anyway.
Yeah, exactly. You deploy a parachute, it creates drag, it catches the air, and it slows your descent. It's just basic physics.
Hmm.
But imagine you jump out and the parachute strapped to your back isn't made of nylon. It's this incredibly heavy, like lead-lined canopy.
Oh, man. You would expect to just plummet. I mean, you'd expect gravity to just absolutely take over the entire situation.
Right. The absolute last thing you would expect is to suddenly start accelerating upward into the clouds.
Yeah, that would be a completely broken physics engine right there.
Which brings us to the stock market today, because that's exactly what's happening. The physics engine appears to be completely broken.
It really does.
We are looking at a market landscape that is, frankly, defying gravity in real time. So we're diving into Monday, August 24th, 2026, and we've got our hands on the morning's institutional-grade research brief.
The good stuff.
Yeah, this is the raw data the big desks are using right now, just ahead of the opening bell. And the mission for this deep dive is to unpack how this market is functioning under such an extreme level of tension.
Because the tension is massive today.
It's massive. Right out of the gate, the big picture is just massively bifurcated. We're looking at S&P 500 futures, and they're down about 9.25 points, consolidating right around 7,682. It's heavy, it's struggling, but then you look over at the Nasdaq 100 futures and it is showing serious muscle. I mean, it's up nearly 100 points, sitting at 29,141.
It's wild. To understand how an index can surge while the broader market struggles so much, we really have to look closely at that lead line parachute you just mentioned.
Right.
Because in the financial system today, that massive gravitational pull, the thing dragging on the S&P, is the 30-year U.S. Treasury yield.
Okay, let's get into that.
Yeah, it has surged above 5.3% this morning, which is a nearly two-decade high.
Wow. Let's slow down and actually explain why that matters to, a casual observer. Because we hear about bond yields constantly on the news, but mechanically, why does a 5.3% yield act like gravity on the stock market?
Well, it comes down to how businesses fund their growth, right? And how investors calculate risk.
Okay.
The 30-year yield is essentially the benchmark for the cost of capital over the long term. So if you're, say, a mid-sized company, maybe a logistics company, and you're looking to build a new warehouse or buy a fleet of trucks, you have to borrow money.
Right, you go to the bank.
Exactly. But when the yield is this high, borrowing becomes astronomically expensive.
Yeah.
Your profit margins get squeezed just paying the interest on your debt, let alone the principal.
Oh, I see.
And on the flip side, if you are a massive pension fund manager, you look at a 5.3% yield and you realize, hey, I can get a guaranteed risk-free return from the U.S. government just for parking my money there.
You don't have to roll the dice on the stock market.
Exactly. You don't need to take that gamble. And that dynamic physically pulls capital out of equities and funnels it into bonds.
Okay, here is where I have to push back a bit, though.
Sure.
If that 5.3% yield is this incredibly heavy parachute pulling capital out of a market, which, we clearly see happening to the S&P 500, why is the Nasdaq actually running faster this morning?
That's a great question.
Like, how is it just ignoring the mathematical gravity you just described?
It has everything to do with the architectural makeup of the Nasdaq today. The index is being heavily buoyed by mega-cap technology and semiconductor companies.
The giants.
The absolute giants.
Yeah.
Think about the balance sheets of these companies. They're sitting on mountains of cash. They aren't reliant on going to the bank and borrowing money at 5.3% to fund their daily operations.
Oh, right, because they already have the capital.
Exactly, because they don't have that debt burden. The cost of capital doesn't hurt them the way it hurts a traditional manufacturing company or, a small cap stock. In a weird way, these mega caps actually act as a counterbalance. Well, their cash hoards are basically the hot air balloon offsetting your lead parachute.
Yeah.
They are actually earning that 5% on their own cash reserves.
Oh, wow. That paints a really clear picture. So the mega caps are just sort of hoisting the rest of the tech index on their shoulders because they are completely immune to the borrowing costs.
Yeah, that's exactly it.
But if I'm looking at the people who actually pull the levers of the economy, the Federal Reserve, how does this extreme yield impact their playbook? Like, are they looking at a 5.3% yield and panicking, thinking they need to step in and fix it?
The irony here is that the bond market is actually doing the Federal Reserve's job for them.
Really?
Yeah. Current market pricing points to a very high probability of a Fed pause at their upcoming September 15th and 16th FOMC meeting.
Okay, because the traditional mechanism for cooling down a hot economy is to hike interest rates, right?
Right.
Which makes money more expensive.
Right. But the open market has already pushed the 30-year yield up to 5.3% on its own. Borrowing is already incredibly restrictive.
So the Fed can just, what, sit on their hands? They just let the long bond yield do the heavy lifting of tightening the credit markets?
They can afford to wait, yeah. And that is exactly why all the institutional desks are hyper-focused on this afternoon. At 2:00 p.m. Eastern today, U.S. Treasury Secretary Bessent is scheduled to speak.
Oh.
And the market isn't tuning in for just like standard economic commentary.
Hmm.
They are going to parse every single syllable to understand the Treasury's debt issuance strategy.
Because that dictates supply.
Exactly. When yields spike this fast, how the government chooses to issue new debt, like whether they flood the market with short-term bills or long-term bonds, can dramatically alter where that 5.3% yield goes next. It's arguably the primary catalyst of the day.
That makes total sense. Now, if borrowing is that expensive here in the U.S., it makes me wonder what happens when you zoom out. Because money doesn't just sit still in a vacuum.
No, it never does.
We have this 30-year yield dictating the U.S. market, but it's causing, well, violent ripples globally.
The global bond market is basically a single, interconnected ecosystem. What happens to the U.S. week? 30-year yield instantly sends shockwaves through foreign exchanges.
Yeah, let's look at how the rest of the world is absorbing that shock, because the reactions in the brief are a bit all over the place. Over in Europe, markets are acting really cautious. Bond yields in France and Germany are mirroring the U.S. ascent, which is leaving their main index, the STOXX 600, struggling for direction.
Even though Germany just confirmed some growth.
Right, Germany just confirmed 0.2% Q2 GDP growth, but the market is still struggling. And then you look at Asia, and it's completely mixed. Hong Kong's Hang Seng slid 1.73%, specifically on these rate fears.
Wow.
While Japan's Nikkei actually managed to bounce about 0.86% because the yen stabilized. And scattered in the briefing, we have these other random economic data points, like Canada is reporting corporate profits dropped 2.0%, while New Zealand's core retail sales unexpectedly beat expectations at 0.7%.
It's a lot of noise.
It is a lot of noise. So my question is, why should a listener care about these foreign data points? If I'm managing my own retirement portfolio here in the States, how much does a drop in Canadian profits or a bump in New Zealand retail actually matter to me on a Monday morning?
I mean, realistically, a retail investor isn't going to buy or sell the S&P 500 based on a single retail sales report out of New Zealand.
Right.
But institutional traders care deeply about what those combined numbers represent because they all track back to a single crucial metric, and that is global liquidity. Think of the global financial system as a giant interconnected plumbing network.
Okay, I like that analogy.
Central banks all around the world are staring at the exact same 5.3% U.S. Treasury yield that we are.
And capital is fluid. It flows to wherever the risk-to-reward ratio makes the most sense.
Let's walk through the mechanics of that. So
Yeah.
imagine you manage a massive pension fund in Frankfurt, Europe. You see the U.S. government offering a guaranteed 5.3% risk-free return. Meanwhile, European bonds are offering significantly less. To get that higher return, you have to sell your euros, buy U.S. dollars, and purchase those American bonds.
Right, there's a currency exchange.
Exactly. When institutions do this on a massive scale, it creates a vacuum. It physically sucks capital out of foreign markets, out of emerging economies, and funnels it straight into the U.S. dollar.
Wow.
So when an institutional trader watches Canadian corporate profits dip or European bond yields climb, they are really just monitoring the water pressure in that global plumbing system. They want to see how fast the capital is draining from the rest of the world to feed this U.S. yield beast.
You're watching the water pressure to see where the pipe might burst or where the reservoir is filling up.
Exactly.
And if global liquidity is actively draining into the U.S., that brings us to a part of the market that usually operates completely in the shadows. We have to talk about the dark pools.
Yes, the dark pools.
For listeners who might not be deep into, market microstructure, dark pools are off-exchange trading venues. They're private networks where massive institutions like pension funds, hedge funds, can move staggering amounts of money without immediately tipping their hand to the public order book.
Because if you place a massive trade on a public exchange...
Right, you risk moving the price against yourself before your order is fully filled. Everyone sees you coming.
Exactly.
So dark pools prevent that. If you want to know what the smart money is actually doing, you have to look at the dark pool tape. And this morning, the signals coming out of it are massive.
The volume we're seeing ahead of the bell is highly unusual.
Let's start with the S&P 500 ETF, the SPY. The brief reveals over $3.24 billion in bullish dark pool inflows.
That is a staggering amount of capital.
It's huge, but it gets even more targeted than that. There was a highly specific options trade spotted in the dark pools. A $3.5 million put sale at the $728 strike, expiring on September 18th.
Okay, the September 18th expiry.
Right. And the brief labels this put sale as a bullish signal, claiming institutions are building a floor. But I have to unpack this. I got to challenge this premise.
Go for it.
Usually when people hear the word put, they think a stock is going down. A put option gives you the right to sell a stock at a certain price. If an institution is selling puts, couldn't this just be, I don't know, one leg of a massive, complex derivative strategy, like an iron condor or just a hedge against a different portfolio entirely? Is it dangerous to assume it's just a pure directional bet that the market has bottomed?
It is a phenomenal pushback, and honestly, you are absolutely right to be skeptical of single options trades in isolation. Institutions do run incredibly complex multi-leg derivative books.
Right, they're not just day trading on Robinhood.
Exactly. However, in this specific context, the mechanics of the trade and the surrounding dark pool volume tell a much clearer story. So when you buy a put, you are buying insurance against a market crash. But someone has to sell you that insurance. When an institution sells a naked put of this magnitude, they are legally obligating themselves to buy the underlying asset if it drops to that $728 level by expiration.
So they essentially become the insurance provider.
Exactly. By taking on that massive obligation, the institution is acting as the backstop. While it could theoretically be a hedge, the sheer size of the premium collected, combined with that $3.24 billion in straight equity accumulation we just talked about, points to extreme directional conviction.
They're putting their money where their mouth is.
They really are. You don't collect a few million in premium and risk billions in downside exposure unless your quantitative models are screaming that the market won't collapse below that point. They're essentially drawing a line in the sand at $728 and saying, we have the capital and we will step in and buy everything if the market falls to this level.
Wow.
That physical willingness to absorb selling pressure is what builds a floor in the market.
That's fascinating. So if you're listening to this and wondering if you should be buying the dip on your own index funds, this $728 floor is the critical metric you need to watch. It's a multi-million-dollar vote of confidence that 728 is the absolute bottom for the near future.
Yeah, it's a huge signal.
But that circles us back to our initial paradox. What on earth is giving these institutions the confidence to build a multi-billion-dollar floor while that 5.3% yield parachute is still strapped to their backs?
To answer that, you have to look at the very top of the food chain. The mega-cap tech stocks that make up the lion's share of the index's total weight.
The magnificent anchors. Let's look at the tape for these giants because the scale here is just hard to comprehend.
It really is.
Apple is trading near $309. It currently has a market cap of $4.9 trillion. Just let that number sit for a second. $4.9 trillion.
It's basically a sovereign nation at this point.
It really is. And looking at the dark pools, Apple is seeing over $2.12 billion in bullish accumulation this morning. Microsoft is showing similar strength. It's holding steady around $483.24, and that's supported by block trades north of $1.01 billion.
That kind of pre-market volume is a physical manifestation of institutions seeking safety. They're hiding in the most cash-rich companies on earth.
I sort of think of them as the offensive linemen of the stock market.
I like that.
You have this massive crushing pressure coming from the bond market, trying to sack the quarterback, the broader indices like the S&P 500. But as long as these multi-trillion-dollar behemoths hold the line, the market survives. Specifically, the brief notes that if Apple can hold that $309 support level, its sheer size protects the broader Nasdaq from buckling under those yields.
The offensive line analogy works perfectly because, an offensive lineman isn't supposed to score the touchdown.
Right.
They just provide an impenetrable wall of support so the plane can develop. But if we want to talk about the player actually moving the ball down the field today, we have to look at the primary catalyst.
Nvidia.
Nvidia, the absolute heartbeat of the AI trade.
Yeah, it is currently trading near $214.72, with a market cap of $4.78 trillion. And despite the tension out there, we are seeing $1.84 billion in bullish flow ahead of a major catalyst.
The institutional flow is undeniably bullish, but Nvidia is facing a critical technical test right at the opening bell. The magic number for Nvidia today is $220. Reclassing that price point is the litmus test for the entire market today.
Okay, walk us through the mechanics of that. Why is $220 the line that determines if this morning's Nasdaq gains are real or just fake?
It serves as a key resistance level based on its recent consolidation patterns. If Nvidia can push through $220 and actually hold that level with sustained volume, it validates all those billions of dollars in bullish dark pool flows.
It proves they weren't just bluffing.
Right? It proves the market has the strength to absorb the selling pressure.
Right.
But if it pushes up to $220 and violently rejects,
Then what we are seeing right now is just a bull trap.
a bull trap in its purest form. For the listener, a bull trap is this cruel market mechanism where a declining asset temporarily reverses and goes up. It breaks through a minor resistance level, tricking retail investors into thinking the bottom is in.
Oh man, they get FOMO.
Exactly. They rush in to buy, which ironically provides the liquidity for the institutions to sell at a better price. Once the institutional selling overwhelms that retail buying, the asset suddenly reverses again and continues its brutal downward trend.
It's ruthless.
It is. If Nvidia fails at $220, the illusion of strength shatters, and all that heavy gravity from the 30-year yield is going to reassert itself across the entire index.
So if Apple and Microsoft are presenting a unified front and Nvidia is preparing to test a critical resistance level, that makes a lot of sense. We can see the institutional strategy. But what happens when institutional gravity and retail momentum completely disagree on a stock's value?
Oh, that is where things get really messy.
Because that brings us to a stock experiencing a violent, almost theatrical tug of war this morning.
The ultimate battleground stock, Tesla.
Tesla is a true tale of two tapes today. On the surface, the public tape that everyone sees on their trading app, it looks incredibly strong. It gained 5.14% in the last session to reach $362.86.
It's a massive move.
It is. It is being fueled by immense retail momentum. People are seeing green and aggressively buying the breakout. But then you peel back the curtain and look at the dark pools, and it is the exact opposite story. The hidden tape shows nearly $1 billion, $947 million to be exact, in bearish outflows.
The institutions are quietly heading for the exits, while retail is storming the front door.
It's a classic standoff. Retail traders are aggressively buying this price surge, completely unaware that $1 billion is secretly flowing out the back door. Usually, I would bet on the institutions winning that tug of war eventually because, well, they have the deeper pockets. But at the opening bell, retail momentum can be completely irrational. How does an institutional trader navigate that kind of chaos at the $360 level?
Institutional traders navigate it by using the retail momentum to their advantage. What you were describing in the dark pools is a classic distribution phase. The institutions have massive blocks of stock they want to sell. But if they dumped $1 billion of Tesla onto the open market all at once, the price would instantly crash.
And they'd ruin their own profit margin.
Exactly. They need a buyer on the other side of the trade.
They need tremendous liquidity.
Right. So when retail traders experience FOMO, the fear of missing out and rush in to buy a 5% pop, the institutions slowly and methodically sell their shares into that buying pressure.
Oh, wow.
The retail buying acts as a cushion, allowing the smart money to exit their positions at a highly favorable price without tanking the stock immediately. That clash right at the $360 resistance level is the ultimate real-time test of retail sentiment versus institutional reality.
It's fascinating to see how the sausage is made. So, as we get closer to the opening bell, let's pull all this together for the listener. The overarching narrative of this entire deep dive is a multi-trillion-dollar wrestling match.
That's a good way to put it.
In one corner, you have the oppressive gravitational weight of a 5.3% 30-year Treasury yield, the lead parachute dragging on corporate borrowing and sucking global liquidity out of foreign markets. In the other corner, you have the staggering buoyancy of the tech giants.
The hot air balloons.
Right. You have Apple defending $309. You have Nvidia fighting to break a bull trap at $220. And you have institutions quietly building an insurance floor at $728 on the S&P 500, while simultaneously using retail momentum as exit liquidity for Tesla.
It is a masterful beautiful, real-time display of market mechanics. The big desks are carefully placing their chess pieces to survive this yield environment.
They really are. But if we step back and look at the architecture of what we just discussed, it raises a much larger, almost geopolitical question to leave the listener with today.
Definitely.
We are witnessing a dynamic where just 3 or 4 American companies are valued at nearly $5 trillion each. They are acting as the sole load-bearing pillars keeping capital in the U.S. index against multi-decade high interest rates. But as we discussed earlier, to feed this beast, that 5.3% yield is physically vacuuming capital out of Europe, Asia, and emerging markets.
It forces foreign central banks to react, often harming their own domestic growth just to try and keep up.
Exactly.
Yeah.
So here is the lingering thought to ponder as you watch the tape today. If U.S. yields continue to act as a black hole, sucking global liquidity away from developing nations just to prop up American AI companies, what does that multi-trillion-dollar concentration of wealth do to the stability of the rest of the globe over the next decade?
It's a scary thought.
Are we funding our tech boom by destabilizing everyone else?
It's a fascinating dynamic to monitor, especially with the Treasury Secretary speaking at 2 p.m. today.
Absolutely. Something to keep in mind as the bell rings. Good luck out there today.